V and U formation. Now, this is not super important, but this is something that carries a lot of intrinsic value. And I want to take this lesson and talk to you about the different market movements, and in particular, the fact and the way to explain the market movement. One of the secrets to successful trading actually lies in understanding why the market does what it does. And every movement, remember, there are no coincidences whatsoever. There is always a reason for each move. And there is no magic in the market, even though I like to say magic just because I love it so much and this work has been so great to me, so I love to call it magic. But once again, there is no magic. And when you know how to trade or to find an entry, that's all great and it's very useful and it will make you very happy. However, if you can explain why the market does what it does and who did what and what kind of a move was made by what kind of a player, was it a huge market order, was it a limit player, and if you can explain at least some of the moves and you look at the market and you say, there was something happened here, somebody sold off a bunch of stocks or any kind of product here, there was a limit player gathering a position, so we can expect this kind of a move. It all comes down to long-term expectations and being a professional in this work and being able to explain the psychology behind the red and green candle or whatever the color that you're using. And this is the intrinsic part of trading and this profession and this work. And this is probably the hardest part, but at the same time it comes with practice and with attention. And when you're trading and paying attention and giving the respect to this work that it deserves, you will become one of those professional traders that looks at the market and knows what's going on and what to expect, and only then looks for technical reasons for an entry or an exit, or does the calculations in terms of the range, ATR, stops, take profits, and all other things. Now, the V and the U formation, they are very, very basic, but they show different kind of market and big player behavior. And if you can understand and keep this in mind when you'll be looking at the markets in the future, you will soon realize that you are able to explain quite a lot of things that happen in the charts. Now, the V and U formation, once again, they are quite basic, and I'll explain what the difference is. And this difference, it carries the core concept of understanding what happens in the market. So let's go to the screen and I'll show you the V and U formations. Now here in the left window, we have a V formation going down. So this pretty much here is as you can remember, this is a spike and this is a V formation. So a really, really sharp bottom and then going back up just as fast. And this is quite symmetrical, as you can see, and you will find a lot of symmetrical moves in the market, and there are quite easy technical explanations and reasons for this symmetry. Some might be more symmetrical than others, some are just spot on symmetrical, just identical, meaning that it goes down as fast or as slow as it goes back up and precisely to the same price level. And this can be quite, once again, I love saying it, quite fascinating to watch this market magic. Now, here we have a V formation. Now, if we go to the right screen, and I had to make it a larger one so that you understand the idea, and this is the U formation. So we are going down slowly, steadily, controllably, and then we change our direction and we go back up even a bit higher than we previously were. So this is the U formation. So pretty much the difference is in the power and speed of the move and the speed of the change. So if we are going down super, super fast, we might, it's not always the case, but we might, depending on the reason why this happened, we might go just as fast back up and the trend will break just within seconds at some specific point in the market. When the fuel is going to be used up, there was a lot of fuel spent on going down right here on this down move, and then a really sharp move up. And that happened simply because right around the end of this candle, the fuel for the down move was gone. And there was now a lot of fuel for going up. And I'll explain why, where it came from, and what's the difference between these two. And here we had quite a lot of fuel going down still, but it wasn't used up as fast. And then we kept around this level for a short period of time, and then the fuel was emptied around here, and then we slowly and steadily started climbing back up. So you can see the symmetry in both examples, in both the V formation and the U formation, but the symmetry is identical in terms of the symmetry itself, but in the V formation it happens very fast, going down and then sharply back up, so a spike. This one is a really nice round bottom wave, but still very, very, very predictable and very symmetrical. Now let me make this one, let me make it smaller like this, so you can see the comparison with the naked eye. Now, so why does the V work fast and the U work slower? It's just due to the market physics. When it is flying down or up fast in a V formation, there are a lot of limit orders set out along the way, and then just as fast it is going up and buying it all back. So it's pretty much the law of physics in the market. And when it turns sharply and starts pulling the limit orders, going back up, for example, as in this case in the screen on the left, and in the U formation, it happens slower. So pretty much a mirroring effect of buying and the selling speed. So if we were selling really, really fast and really large volume, we'll have a move back down like this, and then by the laws of physics, we'll be buying back the same amount with the same kind of speed. Just the momentum of the move will have a mirroring effect going back up. And this is the reason why the V and the U happen. So where are these powerful moves coming from? The 3 ATR move, for example, in the daily chart, which is not in one of these examples, but there are sometimes 3 ATR moves in the daily chart. How can we get a move of 3 ATR in the market? Now, the explanation is quite simple. The V formation, the one that goes back fast, often is because of one big player having a much larger trade with a, for example, market order, which is perhaps started with a market order. It's a lot larger than the average traded volume. So as I've described before, the reason why a lot of limit players actually create the limit levels is because they gather the position slowly, 50 contracts here, 200 there, maybe 300 here, and so on and so forth, so that they don't scare the market too much, but they still leave the traces, of course, but that's how they do it. But sometimes, for whatever reason, a big player can still, all of a sudden, throw out a lot of stocks, a lot of future, any kind of product with a market order or with a bunch of limit orders, one after the other, creating the V formation. And this is a lot of times unpredictable. It can happen because of a level, but that's one thing. Because of a level, it's explainable. But sometimes, and you will find these situations to happen quite often, because spikes do happen quite often, and they don't happen always because of a level. Sometimes they will happen just out of the blue. And when there was no identifiable level, no reason, no expectation, and no prediction for such a move, then it must be some other kind of reason which is absolutely unpredictable. Maybe some kind of news came out somewhere in the world and somebody got scared because of the fundamental analysis, which we'll talk about as well later. And there might be whatever reason. Maybe some CEO got fired or was indicted for some crime, and suddenly everybody just sold off their stocks. Any reason For whatever reason this might happen, it's unpredictable, so you don't have to concern yourself with those mere facts. So the V formation, the one that goes back fast, is often made, as I've said before, by the larger player who traded suddenly volume that is a lot larger than the average volume. His or her position moves the market a lot, and then as he tries to close it and just goes back as fast. That is why it is so easy to stop such a fast impulse, as I was saying before. When you see a powerful impulse coming with large candles to the level, it's a lot easier to stop it than a really slow, nice one like the U formation, for example, when the market is coming to the level with small, nice candles. When we have the U formation, it goes down smoothly and comes up smoothly. Perhaps this is because we have more people trading and the move is stronger and harder to stop. And it's all becoming more fluid. The limit orders are slowly set out as the move keeps happening and going down. And then as it turns, these limit orders are taken one by one, a lot slower in a very controllable and nice fashion. And these are the moves that I prefer to see when I'm trading the combination of indicators and levels. And if I'm trading just indicators, this is the best kind of a scenario. But when I'm trading purely levels, I love to see V formation. As I enter, it goes right into my take profit. I make my 1 to 3, 1 to 4, 1 to 5, 1 to whatever ratio, and I am happy. So it really depends. It does not mean that you should not be trading the V formation. This lesson was dedicated to explaining what is a technical reason for the moves. And the two different types of moves, the V formation and the U formation. If you'll be able to explain the difference between the two, this is the key to understanding pretty much any market movement in general. All right, this lesson is coming to an end. Please do not forget about your test as always. And happily, no homework yet again. So enjoy some time off and I'll see you in the next lesson.